Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey, Alan, glad to have you back on the show.
Hey Daryl, thank you for having me on your program.
Yes, always love our discussions. When we talk macro, talk stocks and stuff. And so today I want to get into the weeds. So I've been trying to learn more. I've been on this learning journey of more about valuations and really, understanding that more and how to be a more savvy investor. And so that's been a journey that I've been on. It gets very complicated at times, but it's something that I'm just actively practicing. So I do want to jump over to a chart really quick, and this chart is the growth to value stocks chart. And so as we can see, when we have growth stocks outperform, which as we see here, 2000, you had a dot-com bubble. All of these internet stocks were just going crazy. Then you had a correction to where value stocks began to outperform. I think emerging markets were performing well during this time as well. And then we get to, Fed starts printing money, growth stocks outperform again. Value stocks outperform in 2022 to early 2023. And then now you have growth stocks like Nvidia and many others, just on a tear again. And so when you're looking at this chart and just your overall take on the markets, what are your thoughts?
My thoughts are basically that the first impression is this looks like a clear over exaggeration, but the main difference between the top in 2000 and now is that the big tech stocks are highly profitable. So we cannot make a one-to-one direct comparison and assume that because we are more than double as high as we've been um, with the dot-com bubble that now a crash has to follow. Another point is that back then the flight to quality was clearly into government bonds, and today I would question this approach. Of course, pension funds and big institutions have to be invested in government bonds to a certain degree. But what I have observed and what I have also read is that many are not that convinced anymore that this trade is a no-brainer to switch from stocks into government bonds, despite having high attractive yields at the current moment. In the US, you are having 5 point something percent. Here in Germany, we are having 2 point something percent compared to zero a few years before. This is a major difference. But if you can buy dividend stocks that maybe they are not growing, but they are paying 3 to 4% dividends, then this is an easy answer to give where to allocate the capital, at least for me. Others can have a different view on this topic, but I'm not seeing a crash necessarily coming. This does not mean that individual stocks cannot tank, as we will dive deeper into. But those more robust, more stable, big names like Amazon and Microsoft, for example, I do not see them crashing by 50% or something. But a company like Nvidia, for example, I know, and I've been also in this camp, many have been calling for a massive over-exaggeration, overvaluation, and having lost all footing. But we have to remember only back in 2016, for example, many, or 2008, 2009, even market leaders like Intel were money losing, were loss making. The semi industry is one of the most cyclical ones, and drops in demand can come suddenly. And sooner or later, this translates into falling business activity. And we all know that in the long term, stocks always follow the underlying business trends. And so I'd be cautious with the ultra cyclical ones. This also applies for um, companies that are much into advertising business, like Meta and Google. I'd be also a bit cautious. But all in all, in every market environment, there are always opportunities. And if we reflect to close this question, in 2000, when we look at such a chart, or if we look at the indexes, we get the impression that all stocks have tanked by 50%, 70%, maybe 90%, or gone out of business entirely. But this was by no means the case. For example, REITs or tobacco stocks in 2000 have enjoyed great bull markets, and this also applies for other consumer defensive stocks. The typical household stuff we all buy every day. When the valuation is attractive and everything centers around valuation in the long term as a determining risk factor, because we not only have business risks, we also have valuation risks. And if we look at all factors properly and do some due diligence, do some work, we can spot one or the other attractive underlying trend and also investment.
Mm-hmm. Yeah, because I mean, like even when I look at that chart, and I do see certain companies that seem like a good deal. Like obviously, if I'm looking at the Nvidias or the Microsofts, I'm like, hey, these have ran significantly, and but when I look at a company like CVS or a company that pays a decent dividend and isn't like extremely expensive, I guess that could be subjective. Um, I see like it seems like there's a lot of companies that are still, have a decent PE ratio and such and have a decent amount of value. So that's kind of like where I've been. It's like I haven't been jumping on the bandwagon of jumping into like tech semiconductors, and I've just been staying on the sidelines, and it just seems to go higher, right? And I've just been focused on what is either historically cheap and still provides a lot of value. And obviously I'm still working through that with my own valuation understanding and growth. But that's kind of just what I've been focused on.
That's I've been what I've been doing too. You do not or you should not operate against your gut feeling. You have to be convinced with what you are doing, and often this is the right choice in the mid to long term.
Mm-hmm. Yes, yes.
Maybe one more thing I could add. We have the impression that only tech stocks are dominating and pulling up the indexes. But for example, ultra boring companies like Walmart also are making new all-time highs currently. But no one is talking about them in the media. Of course, they haven't doubled and tripled in a relatively short time frame, but nonetheless, this is a absolutely stable business. Um, of course, the stock can correct a bit, but the demand is there and will be there, whether a recession or not. So there are opportunities.
Mm-hmm. Yeah, for sure. So I saw like charts like Target. Target went significantly lower last year, and a lot
Yes.
of that had to do with political stuff in the U.S. and um, during that time. That probably wasn't everything, but Target went close to $100 a share. And so when you're looking at Walmart, Target, stocks in that particular sector, what's your overall view on those types of stocks? Time out. quick break in the action. This message is brought to you by the Rule Symposium. This annual symposium is hosted by the legendary investor Rick Rule himself. It will take place from July 7th through 11th in Boca Raton, Florida. Mr. Rule invites some of the most brilliant minds in macroeconomics and natural resource investing. This year, featured speakers include Danielle DiMartino Booth, Nomi Prinz, Jim Rickards, Grant Williams, Lobo Tigre, and more. Rick even organizes the Living Legends panel where he invites individuals who have built billion-dollar businesses from scratch. Attendees will be introduced to a myriad of companies active in the natural resources space, with the companies invited being the ones that Rick Rule invests in himself. The symposium is held at the Boca Raton, which is an amazing resort with exceptional amenities. I attended in 2023 and thoroughly enjoyed my time there. I went on an amazing cruise with Rick and other investors and CEOs of companies, and even had the opportunity to test drive an Aston Martin for the first time. So don't miss out on this opportunity to have fun and receive high quality education to help secure your financial future. Click the link below to sign up, and I promise you won't regret it. But if you do, Rick offers an amazing money back guarantee. So what are you waiting for? Click the link below to sign up today. Now, without further ado, let's get back to the content.
Many consumer stocks, there are two groups of consumer stocks, the defensive ones and the discretionary ones. And Target, I would say, is a bit more discretionary than Walmart. And their numbers have been weaker. The growth trend has reversed meaningfully, and this is, I think, the main reason, besides the political stuff, that has punished the stock and pushed it down. And we have observed it in among many of such stocks that have a higher discretionary component. Later on, I'm going to publish an article where I have looked at 3 such stocks. For example, Starbucks is also very popular, not only among buy the dippers, but also among the dividend crowd. And the reasoning there, or the arguments there, are Starbucks has had a great history of several decades, and this necessarily must continue, because it is a proof of robustness and that everything's going right in the business. But if you only you do not have to do an ultra deep research. It is sufficient enough for a first impression to only open the last earnings release announcement, read the first 2 pages. It takes you 2 to 3 minutes, and you know what's up. That you will see that the growth isn't there anymore, by no means, compared to what they have been guiding at the beginning of the year. If you open the earnings call transcript and read the guidance, they haven't given the guidance in the earnings announcement, but during the earnings call, you will see that they have pulled back massively with their priorly optimistic view of growth. And now it's not even clear whether they will be able to hold the results from last year. And if you have a company that was valued with a multiple of, let's say, give or take 30x, but it was growing earnings at, let's say, 10, 12%, and suddenly you step with both feet on the brakes, and growth isn't there anymore, you hardly can justify such a high growth valuation. Even 20x would be a bit optimistic. And if you want to do a bit more on the research front, you can just look how Starbucks developed during the recessionary environment 15, 16 years ago. Then you will see it also collapsed massively, because Starbucks coffees are not a necessity of your everyday life. It is a nice to have good, but when the money sits tight, when people are budgeting more or losing their jobs, which happens in economical challenging times, then these Starbucks coffees are not needed. And this also applies to restaurants businesses which are also discretionary, and these are all those stocks that have been nosediving tremendously, and some have also started to cut their dividends, which I would say even 2 or 3 years ago was almost unthinkable for many. If you had a dividend series of several decades, but this situation has changed. Interest rates are high. The economy is slowing down. I don't know whether we will have a recession. And also, it all depends at which jurisdiction you are looking. The US seems to hold up a bit better than we are here doing in Europe. But nonetheless, I would not be too aggressive and too early on the buy the dip side regarding highly cyclical stocks that have come down by, even if it's 30 or 40%. Often it is when you consider valuations and compared with earnings growth prospects for the next 12 to 24 months, it looks more like a correction of an over-exaggeration we had before, and not like a once in a lifetime opportunity many are seeing.
Yeah, yeah. And this is very. I mean, this is a very important discussion because I've talked with multiple guests on my show, and we've talked about the end of like the 20. No, not the 20. The 60/40 portfolio, and how
Yes.
we're in like a individual stock picking environment, like. And you have to know what you're doing, or have someone that knows what they're doing, because like, yeah, it's definitely it's definitely some winners and losers out here. And so when I'm looking at certain stocks, like, telecommunications, like Verizon, in particular, I mean, paying like a 6% dividend, and I was looking over their compounded annual growth rate, which isn't very high. I mean, it's 1 to 2%, and they're paying out about 58% of their free cash flow and such. And so, looking at like telecommunications, I looked at AT&T. That didn't really look too good. And then I know you had, which this isn't the same type of stock, but you had mentioned Zoom before, and I
Mhm.
saw Zoom had fallen more, and so I want to get into like value traps at some point too. But do you have a take on the telecommunication side of things? Because it seems like it's not very many companies to choose from in that particular sector. It's almost like the tobacco stocks. It seems like, when you look at like an AT&T, Verizon, and
Team
what?
US,
Yeah, yeah,
T-Mobile US. Mhm. Yeah, sure. It's a rolled up sector already. It's consolidated, as you said, like tobacco, for example, or like utilities also. I must confess, I'm a bit surprised. Here in Europe, for example, or in Germany in particular, our Deutsche Telekom company, which was a victim of the dot-com crash too, and has been sidewalking and sleeping for almost 20 years. It suddenly has started a bull market for itself. It has been rediscovered. I was skeptical because of the high debt load, but the underlying reason is, and here we are bridging back to the US. T-Mobile US is a major success story on your side, and Deutsche Telekom is a majority shareholder and is indirectly benefiting from this upswing. It has had very aggressive and successful marketing offensive. It's growing by far the fastest compared with this group. So here I think it also makes sense to look at every company individually. If you can spot in a tough or downbeaten sector a company that has the highest growth rate, I think you can have a decent pick. Regarding AT&T and T and Verizon, we have mainly two issues. The first is, of course, the heavy debt load, which is holding them back. And as they are committed to paying their dividends, and they will defend them as long as they can, though AT&T already had a cut, they will unlikely pay off all the debt, but they will need to refinance a big part of it, with every maturity coming in, so that interest costs or cost of debt is rising and pressuring cash flows again. So they are not really growing, or at least having difficulties in coming back to growth. So personally, I would stay out of those AT&T and Verizon stocks. T-Mobile US is a bit different story, but here I have some problems with the valuation. So a few years ago, certainly it would have been a very big opportunity, but now telecoms not.
Mm-hmm. Yeah, yeah, that makes total sense. Yeah, because when you're paying out all that, I mean, the payout ratio. I'm looking at Verizon's payout ratio. It's about 95%. So yeah, they're paying out a lot of their earnings
And
to.
they need to stay competitive. They have to invest heavily in their business, and these investments are never ending. So basically, and inflation is they are losers in an inflationary environment because their equipment is also getting more expensive, labor is getting more expensive, so they not do not necessarily are able to pass those cost increases immediately to the consumers, because despite a consolidated market, there is fierce competition with aggressive offerings, and you do not have necessarily a reason to stay with one or the other. If you have a better deal elsewhere, you can change sides. So they have a rather difficult business. And interestingly, I've also a few weeks ago written about oligopolies, such consolidated businesses, and there we have two fronts. Um, some have been difficult to invest, and on the other side, there have been some which have been successful. Um, the underlying opinion is more that the higher the consolidation, the more concentrated a sector is, the more attractive it should be because margins are higher, competition is less. But this is not necessarily the case. What I've found out is that this applies the more if you have higher growth rates, if you have less debt, and if you have less investments into the business. If you are more on the asset light side, then this might prove to be true, but else it's more very frustrating and difficult investment environment, especially at currently high interest rates.
Mm-hmm. Yeah, definitely. So just transitioning to Zoom, I'm gonna share the chart here, and I know that you had did some research on it, and you were looking
Yes.
into this company, and so obviously, we had the big run up pandemic. Many people work from home. I mean, it hit close to $600 a share, and I don't know when's the last time it's been this price, but it's back to 50. It's down to $56. And so, and there's this concept of like value traps where companies can look really good on valuation, but then like they just don't, perform. And so, what's your outlook on this particular company? Not saying that it is a value trap. I mean, if it goes lower, I mean, it may be a time for where people can buy in at a cheaper price. But what's your outlook on this company?
Yeah, sure. Coincidentally, Zoom has also been a topic of one of my research reports, so I'm a bit biased on this one. But I've tried to do my research, of course, as objective as possible. No question, between 2020 and the most part of 2022, maybe also 2023, this was a massive over-exaggeration, and the valuation was really silly. It was, don't know, 100 times sales or something, but at the top. But the company was also growing very fast, and now it is barely growing, in the low to mid single digits. That's a new environment this company is moving in, but there are also some things I'm not sure people know about. Zoom, for example, is still founder-led. It is a big plus, and the CEO made a very interesting thing. almost near the top of this over-exaggeration. He, for example, did an equity raise. This barely a company is doing such a clever move. To the contrary, most are at the low raising equity when they had bad cash and liquidity management, and are buying back stock aggressively when the valuation has been pumped up already. But Zoom, for example, raised, I don't know the exact sum anymore, but it was a fairly decent amount they raised near the top. And now they have started a buyback program near the low. This is a first indication of good capital management. On the other side, about a third of the entire market cap is in net cash without any debt obligations. So the effective valuation on an enterprise value level is about a third cheaper than it already looks. This is also a big plus, and Zoom has been developing. We all associate Zoom first and foremost as a video conferencing tool. We both today are also talking about Zoom, but it is way more than that. It has also acquired some smaller companies, but mainly it is an organic change from a pure play video conferencing tool more to a working collaboration environment. And this is the competitive advantage I'm seeing at Zoom, because those free of charge alternatives from Microsoft, Google, also Apple FaceTime, and what else there is around, they are standing still where they have started. And interestingly, they even were not able to meaningfully grab market share from Zoom. And especially in the US and in Great Britain, where one would think that competition is even more fierce, their Zoom has been able to hold up their share and is around or slightly above 50%, which should speak for itself. If you have a service you need to pay for, and the others are, as I said, free of charge, and you still have a market share of 50%, they must be doing something right. And with this shift towards the collaborative environment with also some decent AI features they are already implementing into their service, I could imagine that sooner or later this will reignite some growth. And with this, when the fear of Zoom only going sideways or maybe even losing business disappears, then the stock will also recover. And until then, we can wait it out, let them buy back their stock, make use of their huge cash position. At last count, it was, I think, 7 billion or something for a market cap of now less than 20 billion. This is almost unheard of. If all we are aware of and hearing from the big tech stocks is they are generating 30, 50 or 100 billion in free cash flow. They are having so and so much liquidity on their balance sheet. But if we compare this to the market cap, to the size of those companies, this isn't even that much of a deal. These are on an isolated basis big numbers, but in relation to the whole, it's nothing to freak out about. But if you look at smaller companies like Zoom Video, then it looks from a pure investment perspective, and by looking at the numbers, it looks for me very interesting, and there should be a decent enough margin of safety at this valuation stage. This does not mean that the stock cannot fall further. Markets can remain contrary to what you think for longer than you wish for.
Yeah.
The only thing that would tear apart this thesis is if Zoom really would start to shrink organically. If it loses customers, if it is not able to pass on price increases, and if we see sales rates falling, then I think I would pull the brake on this one. But for now, sales are growing by 3 to 5%. The same on the bottom line. Cash flow is strong. I know that stock-based compensations are a bit dragging on this one because more shares are being issued or have been issued in the past. But now, as prices are lower, this should become less of a problem, and the buybacks are able to at least compensate that. And should they up their buyback, which is realistic, then I think a share count effectively can start to shrink, and the constellation looks fairly decent and interesting at this stage.
Mm-hmm. Yeah. That's. I mean, that's that's a really good assessment. I mean, especially with the market share when you're looking at, which I know at like my main job, I work for a government agency. We use government agencies
Mhm.
tend to use Outlook and Microsoft, and so we've used Microsoft Teams, obviously. But outside of that, like I mean, we're using Zoom right now, and and so like for that market share to still not be as impacted is really critical. And it's also like one of those things where I think about what companies can do well, like in terms of like really focusing. Like Microsoft, they do a lot of stuff, like phones to you know to email platforms to now they
Mhm.
got a video and a chat function and all this stuff. And it's like, and not saying they're not a good company, but when you think about it, Zoom is like specializing in specific areas, and for their market share to still be pretty significant, and not as impacted. I mean, that says a lot.
Yes, clear. The focus is a completely different one. One is a bonus option. Zoom could be taken over by, let's say, Salesforce, for example, which has been a serial acquirer. It has no such solution in its portfolio. This is thinkable. And also, interestingly, Zoom has a even higher market share in the educational sphere. And for example, you cannot do webinars, which are also very a very useful tool via Teams or Google. I've forgotten how their solution is named. Google video conferencing. Yeah, correct. Google Meets, I think it was. This webinar solution from Zoom, it costs extra. It is not integrated in the standard version, but people are buying it also for their special purposes. So I think uh, it is not fair to say Zoom is just a legacy video conferencing solution that is overcharging while others are for free. It is way more than that. If you um, understand this, I think it is easier to be optimistic about the future of Zoom.
Yeah. I mean, that's good. So I want to go ahead and look at your Twitter. So our X account. So if you're not following Alan, be sure to go follow him over here on X. So you posted this. So I've been looking at PayPal for a while. I've been in and out of the stock. I've been kind of like confused on it, like feeling like, oh, it seems like a good buy. It seems like, this seems like a solid company, and especially, I mean, I use PayPal. I know a lot of people that use PayPal, and you mentioned that it potentially has a potential to disappoint further, and it could be a value trap. So, could you explain to the audience what a value trap is, and why do you think this company is likely a value trap?
Yeah, in layman's terms, value trap is a situation or a stock where it looks valued more on the cheap side, but and many people think it is a great buy, go in, but the thesis doesn't materialize and the stock doesn't rise, and in the worst case, it even continues to fall. Such a prime example with a longer time chart would be the tobacco sector. in my view. But regarding PayPal, I think the key is to understand that the valuation, it is not likely over-exaggerated, and it looks fair to cheap. This is true, but you cannot do such an assessment without looking at the business and especially at the business prospects. And after having done some research, and also after having opened my eyes and ears in everyday life, I came to the conclusion, despite being a PayPal user myself, but only privately, not on the business side anymore, because I had some issues with my invoicing plugin, which didn't collaborate finally. PayPal seems to be more like a legacy desktop application. I know one can use PayPal on the smartphone, but I haven't seen anyone paying with PayPal in the supermarket, and the trend is clearly going more towards mobile payments. I think no one will say isn't true. Desktop will likely remain somewhat stable, but we are missing the growth component that has been lifting PayPal in the past, especially when it reached its very lofty valuations. I think it was 3 years ago with a 50 times earnings or something like in the range 16, 15 times sales. Way too much, because everyone thought we would be only shopping online and not go to department stores or supermarkets anymore, which, as was proven, wasn't the case. And despite online continuing to grow, PayPal has not been able to fully participate on this one, and competition in the mobile payment area is way bigger than it is on the desktop side. First and foremost, Apple Pay, but you also have Google Pay, Samsung Pay, and all the other alternatives. For credit card payments, you have Stripe, which is a very handy tool, very user-friendly, and this is why for example, personally am using Stripe and not PayPal. It has been working out better for me. So I think that, and what is also interesting, if we are crunching some numbers, PayPal has been losing in its take rate. Take rate is the percentage or the margin it is grabbing from the whole payment volume for itself as a fee. And on this side, with its branded PayPal checkout service, it has been losing tremendously. The margin has come down by a third or so over the last 10, 12 years. And this for me is not a sign of strength. I know that they have launched their Venmo service in the meantime, but for now it is US only, as far as I know. Here in Europe, there is no Venmo. And the other thing is that there are unbranded services via Braintree. That's a nice option, yes, but it is a way lower margin, so they need to go for the on the volume side to make up for this. But as I said, the mobile payment is heavily competitive, so I do not necessarily see them coming back to their former high growth stage, and they are also having issues with their stock-based compensation. So they are effectively shrinking their share count, but a lot of free cash flow and the buyback program is going to compensate for the stock dilution they are doing. So in a sense, the stock is not cheap enough for me to consider it right now, and I see more risks and challenges to formulate it a bit more positively than I see no risks and only pure upside, like it seems many are seeing in it, only because the price has dropped. But if we are honest, we have seen this such a type of post and buy the dip messages when PayPal was at 200, when it was at 100, when it was at 80, at 70, at 60. who says that it cannot fall further?
Yeah, 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 for sure, for sure. I'm not in it, by the way. Disclaimer: I'm not. I haven't touched it in a
Me
while.
neither.
I was looking at it again, but then I was just like, nah, I need to just stay away.
The case is not convincing enough. There are too many risks, and the environment is too competitive. Maybe there has to be some consolidation, one or two names stepping out. We also have Amazon Pay. I've forgotten to mention it, which is very strong and growing. So today's PayPal is not the same. It has been years and a decade ago.
hmm Yeah, yeah, for sure. So I mean, a company like Amazon. I mean, you mentioned them earlier. Um, they haven't ran as much as like, well, I can't say they haven't ran. I mean, I know they did some like stock splits and stuff, so the price is a lot lower. Same thing with Walmart, because I remember Walmart was over $100, and then now it's like at 67 US dollars. So I didn't look at the chart, but then when you said, I just looked at it a second ago when you said, oh, they're hitting all time highs, and then so I saw it at 67. I said, oh, they must have did a stock split.
Yeah,
Yeah,
correct.
correct.
There
There
was a
was a
split.
split. Yeah, yeah, yeah. So yeah, I was just thinking about that. So a company like Amazon. I mean, Amazon, obviously was a big name, for a while. Still is huge, huge name. Um, what are your thoughts there? Like, I mean, could you mention like Amazon and Microsoft, kind of they're being more, um, not necessarily overvalued. Was that, did I hear you correctly there?
Um, Using historical valuation patterns, and if you have an alternative to go into bonds, if you believe in them and in their stability, then they traditionally should be a bit overvalued. But as those big tech stocks seem to have a higher quality now, I think they will hold up rather well. And Microsoft is fairly diversified. They have a growth engine with their server and AI business. And despite not liking Microsoft at all, because I'm a pure Apple user, so this is also some conflict of interest on my side. Um, okay, okay. Yes, I've grown up with Microsoft with MS-DOS, programming a bit, starting computer games from a floppy disk and such stuff. Um, I know Microsoft, but as soon as I discovered alternatives, first Linux and then later the Apple ecosystem, it was clear for me to never return back to this stuff. So it would be hard to convince me also about the stock. But I think their business is stable enough. They have also a high amount or high component of a subscription business, which is more stable than one-time payments as they had before with their software. So and they are not that big in advertising like yes, Google and Meta, which consist mainly of advertising revenues. I think this is it's not cheap. I would not go into it, but those people that hold it or have been holding the stock for say 5 years or more, it speaks nothing against it to hold it only on the premise of comparing it to alternatives, which is a government bond. But because as we know, inflation is still there. Media is suggesting that it has come down massively. But if we are honest, if we are looking on our on our bills and on our everyday purchases, we can fairly safely say that the real inflation rate tends to be a bit higher. So holding big cash positions is also a bit questionable, even if you can grab some interest rates, or I don't know, 3-4%, depending on the broker you are using. Um, yes, that's on Microsoft. And regarding Amazon, I must confess I've never had Amazon stock. That, of course, in hindsight, this was a big mistake. despite being a user myself. My first purchase on Amazon was in 2009 or so, and already then their service was great. So, but I was not active in stocks back then. That was likely mainly the issue. This should have been the logical consequence to buy stock when I'm a consumer and when I'm happy with their service. But I haven't done that. A big learning for me. But until today, when I started to do more business analysis, to jiggle around with numbers and to read business reports and so forth, it is almost impossible to do a serious valuation of Amazon because they are always investing, always growing, opening new branches and services and product alternatives. They are testing also a lot, then here or there throwing in the towel, for example, like with their smartphone, Fire smartphone, which was a major flop, but nonetheless they tried it. And they are, I think they will, of course, continue to stay in business to also grow in market share on a worldwide basis where they are active. But it is tough for me to value them. And with this, we are coming back to the point of gut feeling. And when I cannot find the numbers I'm looking for and to calculate business value of a operation, then unfortunately I have to pass on this one because I am not convinced enough to allocate capital into this one, despite it having had a tremendous history.
Yeah, for sure. Yeah, I definitely understand that. I'm kicking myself because I was buying Amazon at $80 a couple years ago, a year and a half ago, and
Okay.
yeah, and I was just so bearish on the market, and didn't realize like, oh well, I'm already like buying, close to the at least that local bottom or whatnot, and so yeah, it was a few companies like that. I missed out on Nvidia, and I had Meta at like I was buying Meta at like 90 something dollars, and I was so caught up into the bear market camp, the echo chamber, and I was thinking like, oh, these stocks are gonna get crushed even further, and they were significantly cheap back then. So yeah, I mean it's
Yeah,
instant.
the same with Apple on my side. For example, there's a German language video on YouTube still from 2018, I think it was, where with a former colleague at a former employer, we were discussing the case of Apple. It was trading at a enterprise value to free cash flow multiple of 9, buying back 10% of their stock each year at such a low valuation when everyone, or almost everyone, thought this company has reached its peak. It's not progressing anymore. What new shall they bring on market? The iPhone was there, the iPad was there, Mac and so forth. The improvements were only becoming minor and minor with each year. Consumers were not upgrading every year, but maybe every second or third year. This was the bear case, but the fact of the matter is that they didn't need any organic growth to justify this absurdly low valuation because due to the buyback alone, this valuation was more than justified, and every piece of organic growth was a bonus on top. I was holding Apple stock back then personally also, split adjusted. What was it? Split adjusted. They have split it 4-for-1. It was 100 back then, so it should be 25 today, and it's now around or above 200 today. But yes,
Yeah, you can't win them
too
all.
early out.
Yeah, can't win them all. But in even though we're talking about companies that we missed on, like I want to share screen. So this is the total return for your newsletter.
Yes.
I don't know if this is year to date or what, but yeah, you posted this on June 3rd, and it looks like your stocks that you've been picking, that you've been doing the valuations on, have outperformed, the S&P and even the world MSCI World Index. And so, where can people find more about you? I mean, people want to experience these types of gains, Alan. They want to win, and they don't want to be the losers in this stock picking world. And we just covered a lot of stocks, and so I appreciate you for coming on. But where can people find more about you? What can they expect when they become a member of your newsletter?
Yeah, thanks, Daryl, for showing these numbers. They are per end of May, for full disclosure. And for every sophisticated stock picker who's interested in it, everyone is welcome to join my growing member base. I am doing a deep business analysis and writing 12-page concise research reports about every case. My main goal is to find cases that are not complex and overcomplicated, but to easy to understand, easy to digest, and with a fairly straightforward thesis. Everyone should understand quickly and easily. For example, Zoom is such a topic we discussed today. It's has been one of my reports, but I've also been fairly engaged in the commodity sector, met coal, for example, or uranium, also energy, oil, mainly the offshore energy sector. So there are several topics worth to be explored, and with one or the other idea that is not necessarily on the mainstream radar, and everything must pass my business analysis and valuation filter. And if the package is right, there are no red flags, and I have difficulties to say no with my risks first approach, then I'm writing reports, 11 in total per year if one decides for the Premium Plus membership.
Mm-hmm. Yeah, that's. I mean, that's amazing. Next time you come on, we got to talk offshore oil, offshore. I've been looking into it. A
Hey,
good
happy
friend,
to.
yeah, a good friend of mine. He's big into it, and we've been talking
Mhm.
about some companies there. I've seen some other people I watch talk about offshore, and so love to dive into that with you. So you all be sure to go to the link in the description. I'm gonna have a link to Alan's newsletter so that you can get access to his research papers and his picks. Also, be sure to follow him on X and Twitter. You all know what it is. Thank you all for being here today, and thank you, Alan, for coming on the show.
Thank you, Derry, for inviting me, and good night.